Investors, by the time this piece airs, will have already made it through about 75% of the S&P 500 earnings releases, including most large cap technology stocks. The Federal Reserve will have already met for their early May meeting and disseminated their collective wisdom on the economy and interest rates. Investors, for those of you only listening to this week's Stock Talk, please note you cannot see or feel my level of sarcasm around the term collective wisdom when I talk about economists and the Federal Reserve members. In last week's piece titled The Good, the Bad, and the Ugly, we once again updated and covered 3 data series we follow in real time, which have been very good leading indicators for broad market moves, and they've been even fairly accurate in catching smaller, shorter-term squiggly lines which form from a trading standpoint, which are fun, but from a long-term investing position are fairly irrelevant. The good was the real-time data was saying inflation expectations were peaking 2 weeks ago, just as the doomsdayers were getting most vocal about its return. Investors, the real-time 5-year inflation break-even rates. We posted this chart before last week's rally, noting the similarities to its late October 2023 peak, about 4 or 5 days before the stock markets troughed and promptly rallied 1,100 S&P 500 points in almost exactly 5 months. Inflation expectations and statistics in the U.S. are very seasonal. That was the good news. The second, bad news, and most likely reason for the broad market sell-off during the first 3 weeks of April, the bad news was the pivot higher, not lower, in 5-year real interest rates. Remember, investors, this is the interest rate that comes most close to accurately forecasting whether investors are willing to pay higher PE multiples for the market or lower PE multiples. Investors, higher real interest rates historically compress PE multiples, while lower trending real rates historically lead to higher PEs and higher stock markets over the past 15 years. Finally, the ugly. Well, the ugly was we continue to follow the pattern of October 1988 through 2000, when the dot-com bubble rally happened, but the Federal Reserve stayed too tight. It eventually caused a recession in 2001. Of course, stocks anticipate future economic events, and the first leg down in the multi-year bear market began in mid to late summer of 2000, with the S&P 500 dropping minus 30% into the first quarter of 2001. Investors, stock market bulls want to avoid this outcome, while bears relish in this overlay, hoping they'll finally be right after 10 to 12 years of calling for a secular bear market. Which brings me full circle to this week's piece. Back to our regularly scheduled program, return to the old normal. Take a look at the daily chart of the S&P 500, including last week's rally. Investors, 5 months up from late October 2023 through late March 2024, almost spot on to the day. As our team had expected back in late October 2023, the cash S&P 500 rallied 1,100 points, which met our optimistic expectation for the first half of 2024. We discussed this for the better part of 6 months during the second half of 2023, while many others were talking recessions, or worse yet, market crashes. Our team had this very positive outlook because this is what the old normal historically looked like during the second half of the third-year presidential cycle in the first quarter of the fourth year. That factor, as well as it's quite historically normal to have a big rally when the Fed merely pauses after a series of big interest rate increases without cutting interest rates. So where do we go now? What's more normal look like? Well, here it is, remembering that there are no guarantees or perfect in the stock market. This could be the forward path for the stock market, at least through late summer. This path has been derived from many of the same sources we often quote at Oak Harvest on the investment team. Who falls in this group? Those are the strategists, technicians, chartists, and historians who've been proven over many cycles to be both accurate while also being pretty precise in their calls. Larry Williams and his great stock market cycle work. Steve Suttmeier and his quant data group at Bank of America Merrill Lynch, and chartist Rich Ross at Evercore, to name a few. Take a look at 2 charts from Larry Williams, which he first published in late 2023 for his 2024 forecast. The first of these charts is Larry's natural cycle forecast for 2024, which takes prior year patterns, compares it back in time to similar time periods, and projects forward what the next year could look like based on that. Remember, investors, trend is more important than absolute levels in most of Larry's work. However, so far so good on this forecast of 2024. If projected in early down January, check. A significant rally into mid-March to new all-time highs, check. And then about a 3-week sell-off into mid-April, triple check. Before finding a bottom and heading to new all-time highs into summer, where one wouldn't worry again until after July 4th or into August for one more down move into the third quarter pre-election. That one remains to be seen. The second of Larry's charts, which we referred to months ago and used in late October 2023 to support our positive outlook for the fourth quarter of the year and the first quarter of 2024, that one, it's his daily long-term cycle projection. Here's that chart again. His projection for 2024 is the red line. It too has been money as it forecast a big first quarter 2024 rally to new all-time highs in late March before a seasonally normal weak, first part of April. This work also supports another bout of weakness to come over a mid-May period before a strong early summer rally, taking the markets back to at least towards new all-time highs they reached in March. Call that a rally back to 5250 on the S&P 500 into July 4th weekend. Another strategist work we follow is Steve Suttmeier's work at Bank of America, which also supports this forecast for the next 3 to 4 months. Take a look at the monthly seasonality of the S&P 500 for the fourth year in a presidential election cycle since 1928. The average 4-year returns have April flat to down a bit, and we did see a minus 5% sell-off this year, the first 3 weeks of the month. May has historically been the worst month of the fourth-year cycle, averaging a loss of close to 1.25%. However, under this forecasting tool, investors should not be panicking as May has historically been the low for the remainder of the year, most presidential election years. Looking at this pattern of returns, and this one only, one has seen a cumulative positive return of almost positive 6.75% post-May during the summer months of a rally from June through August. Using this pattern and this pattern only, a quite normal scenario for the next 4 months could see the cash S&P 500 resuming its down move into late May, making a new marginal low versus the S&P 500, call it 4,900, before rallying strongly into the summer months. Call it a rally back to near its all-time highs of about 5,250 on the S&P 500. However, investors recall that the 10.2% rally in the S&P 500 in the first quarter of 2024 was the 14th best first quarter, going all the way back to 1928. Investors outside of the normally seasonal week period we're entering, and another 2 months prior to the election in November, this pattern has been very bullish for stocks, and the remainder of 2024 and 2025 look good. Back to Sam Stovall's historic work. Take a look at the returns from the best first quarters in the markets in market history. Stovall's data shows that 14 out of the top 15 first quarters since 1945 ended up with additional double-digit percentage returns with no down years. The only outlier was 1987. Those prior 14-year gains averaged 23% total return on the year. Such a total return from current levels would triangulate to cash S&P 500 near 5,850 to 5,900 at year end. However, Stovall's data series also reveals heightened volatility on the way to those outsized gains. 13 of the top 15 first quarters had declines of minus 5% or more, which is standard in any year. And of course, we had that during the first 3 weeks of April. However, the average decline during those years was over minus 11%, which is a little above average. While this upside seems like a stretch even to the most bullish cheerleaders, and I have a hard time getting to these levels by year-end 2024, historically, the markets would say market moves to 5,900 to 6,000 over the next 9 to 12 months is actually more likely than this being a replay of the 2000 dot-com bubble and the markets tanking back to 3,500 to 3,600. So if the very few strategists, technicians, and market historians who've been right for the better part of 2 years, if Larry Williams, Steve Suttmeier, and Sam Stovall's work continues to be prescient, while most economists, academics, and equity strategists who whiffed on their 2023 forecasts, here's a possible roadmap for how the S&P 500 may rally to new all-time highs and beyond in the coming year. No guarantees or no promises from me. For investors or retirees uncomfortable with a wider range of possible equity outcomes, the Oak Harvest investment team has launched a new strategy that retains the ability to go long stocks, short stocks, as well as buy partial hedges or shock absorbers for a stock portfolio. Information on this strategy can be found at oakharvestfunds.com. For myself and the whole team here at Oak Harvest, have a great weekend.